Welcome, everybody. Thanks for joining our monthly Money Life webinar. We've got a lot of information to talk about tonight, and we're going to get right into it. So tonight we're going to talk about the just recently passed One Big Beautiful Bill, or OBA, as we're affectionately calling it. And it is big. Some parts are beautiful for some people. Some parts aren't so beautiful for other people. And we're going to go through all the nuts and bolts. And so a couple of housekeeping items. This presentation will be recorded and it will be shown on our website in the next few days. Also, if someone could just give us a thumbs up that you can see the slides and that you can hear me okay. Yep, all righty. Looks like we're good to go. So joining me today, we brought, because there's so much material, we brought in a big chunk of our tax team to handle this. So we'll be tag teaming a bunch of the content. So in addition to myself, and if you don't know me, I'm Jim Allen. I'm the president and chief financial planner here at Anchor Bay Capital and Anchor Bay Tax. Also with us is Blake Pinion, CFP enrolled agent. Blake is our senior financial planner, and he's also the manager of Anchor Bay Tax. And then joining myself and Blake are Rob Nathan. Rob is one of our financial planners and also one of our tax preparers. And then finally, Corey Large. Corey is one of our wealth strategists, so he works on the portfolio team in addition to being a tax preparer. So we're each going to cover different segments of this presentation. We're definitely going to be filling the whole hour. If we have time, we're happy to answer questions at the end. But if not, feel free to reach out to us directly, email us questions, give us a call, or come in and for a consultation, and we're happy to talk about this in more detail. We also will be providing a lot more content on our website regarding the OBA. There's already a piece that Blake wrote that kind of gives you the rough overview on the first part of it. And so without further ado, I'm going to go ahead and turn it over to Blake to let him kick this off.
Perfect. And everyone can see this slide on rates and deductions, okay?
Yep.
Perfect. Awesome. So thanks for that context, Jim, and welcome everyone. We're really excited to have you. This is hot off the press news with these changes in tax legislation. So we're excited to share with you today and talk about some of the major planning opportunities, notably some things that we can implement before the end of this year. So just wanted to start off with some context and background on the legislation as a whole. So it was signed earlier this month on July 4th. President Trump signed it into law, naming it the One Big Beautiful Bill Act, right? So it was just recently signed, and there's a lot of key noteworthy changes that we're going to talk about throughout the presentation, some new deductions, some new credits, some changes to credits. So we're going to talk about the whole enchilada. And what I wanted to mention as well is there's a lot of key phase outs and things to pay attention to. Now, for those of you who are Anchor Bay financial planning and investment clients, we're going to meet with you personally and to talk about how these changes impact your personal tax situation. But there's certainly things that we can work on prior to the end of the year to take advantage of some deductions that we're going to outline. So starting off with the beginning, the previous brackets and rates that were set by the Tax Cuts and Jobs Act at the end of 2017 have now been made permanent, right? So the tax rates that we've been enjoying from 2018 through now 2025 will continue to be the same through the foreseeable future, at least through the end of this administration. So this is overall a win for taxpayers, right? We're going to continue to benefit from these historically low tax rates. And that certainly opens the door for opportunities of Roth conversions, is something that we're going to continue to look at over these next subsequent years. What's changed, though, for 2025 and moving forward is the 10% and 12% brackets have received a slight inflation adjustment, meaning the income band or threshold for the 10 and 12% rate has been expanded. And this is overall a win for taxpayers because it means more of your income is going to be taxed at that lower 10 and 12% rate. So in technical terms, that means everyone's effective or average tax rate is going to go down slightly. Now, these tax rates that we have are going to continue to receive inflation adjustments beginning in 2026 and subsequent years after. Moving over to the standard deduction side, the higher standard deductions that were set from the Tax Cuts and Jobs Act have now been made permanent, and they've also increased. So what's a standard deduction? Well, when you're filing your taxes, you have the choice of whether to take the standard deduction or a combination of your itemized deductions, and you generally take the higher of the two. The standard deduction is a flat rate that's published by the IRS each year, and it's changed generally based on inflation, whereas your itemized deductions is a combination of your deductible mortgage interest, your state and local property taxes, your charitable contributions, your medical expenses above 7.5% of your income, as well as casualty losses and some miscellaneous items. So you take either the standard deduction or a combination of your itemized deductions. Now this year, we've seen an increase in the standard deduction amount. So as you can see on the screen here, all filing statuses are going to see an increase in their standard deduction. So for single filers, it's going to go up from $15,000 to $15,750. For head of household, it goes from $22,500 to $23,625. For married filing jointly, $30,000 to $31,500. And for married filing separately, $15,000 to $15,750. Now, another new notable change coming out of this new legislation is an additional senior tax deduction. Now, before I get into the weeds of how this works, I want to preface it by saying there's been a lot of confusion lately on the taxation of Social Security benefits in relation to this deduction. And I want to make it clear to everyone listening on the presentation today, this new legislation did not eliminate the taxation of Social Security benefits. So unfortunately, those who are still collecting Social Security benefits are going to have to pay tax on that on up to 85% of their benefits, depending on their provisional income. So this additional senior tax deduction that we were afforded does not impact the taxation of Social Security benefits. It's what's called a below the line deduction. And you're going to see that term below the line in some subsequent slides. Essentially, what that means is this deduction lowers your taxable income, but it has no impact on what's called your adjusted gross income or modified adjusted gross income. So this additional senior tax deduction, again, doesn't have any impact on Social Security. But what it does do is it provides an additional deduction of $6,000 per person or $12,000 for joint filers if you are age 65 or older. And that's effective starting this year, tax year 2025, and it's going to go through the year 2028. Now, what's great about this is people that are age 65 or older, those that are eligible, get this whether they itemize or take the standard deduction. So it doesn't matter whether you itemize or take the standard deduction, you get this as long as you meet the qualifying criteria. The qualifying criteria, of course, is you have to be age 65 plus. And then the other qualifying criteria is that your income needs to be under certain levels. But it doesn't impact your choice to whether you itemize or take the standard deduction. And another part of this is it's in addition to the current supplemental deduction you get for the standard deduction when you're age 65 or older, which stands at $2,000 per person or $1,600 per person if you're filing jointly. But as I just mentioned, this additional senior tax deduction is only eligible for those that, one, are age 65 or older, and then two, have their income below certain thresholds. And for single filers, your $6,000 deduction starts to get phased out when your modified adjusted gross income increases above $75,000. And for joint filers, that's $150,000, and it gets entirely phased out at $175,000 for single filers and $250,000 for joint filers. Now, what's modified adjusted gross income? Well, it's essentially your adjusted gross income added back with like IRA contributions and student loan interest. So from a planning opportunity, right, people that are age 65 or older, if your income is close to that 75 if you're single or 150, some opportunities to lower your modified adjusted gross income so you could reap the full benefit of this deduction. And a couple things that come to mind would be like retirement contributions to a 401k if you're still working contributing to a health savings account, capturing capital losses in a brokerage account, accelerating business expenses. And then the last, what we commonly do for our clients is being intentional about the retirement income that we're sending you from your portfolio if you're retired, right? So instead of just using money from an IRA that's fully taxable, if you have a Roth or a taxable brokerage account, maybe we spread the distributions across 3 different accounts, blend them to keep your income under certain levels. So that's a little bit about the additional senior tax deduction. So putting this all together as it relates to the standard deduction, in 2025, if you're a single filer, you could have a maximum deduction, again, if you're age 65 or older, of $23,750. And that's made up of the $15,750, the new standard deduction, plus the $2,000 that you get, which is the supplemental that we've had in the past, plus this new $6,000 deduction. If you're married filing joint and one of the spouses is 65 or older, that's $39,100, $31,500 joint deduction plus $1,600 supplemental plus $6,000 additional senior. And then finally, married filing joint, you're both 65 and older, you can get up to $46,700 as a standard deduction. So that's $31,500 plus the $3,200 supplemental plus the $12,000 senior. So what this means overall is that this is going to be a huge win for taxpayers. This increased standard deduction is going to mean that those age 65 or older are going to bound to save tax either way, even though their Social Security benefits are still going to be taxable.
All right, thank you, Jim and Blake, for kicking it off. Like Jim said, I'm Corey. If you guys haven't met me before, I'm on the portfolio team, but also help prepare taxes and do some planning. But to get it started here with going on from some of the deductions to now a few of the credits that might be applicable to a lot of you. We're going to start with the child tax credit. So when the bill was passed, the total amount for the child tax credit got lifted to about $2,200. So that's a change from $2,000 before the bill was passed. And then once you start looking 2026 and beyond, it's indexed to inflation. So some years that might be a big increase. Others, if we get inflation tamed, then it might be a bit of a smaller increase. But that is the plan going forward from the bill, is to index it to inflation. And then something that's pretty important to remember is the phase outs do begin at $200,000 for single filers, and that's $400,000 for married filed joint. And the way the phase out works is it's a $50 phase out for every $1,000 above the AGI limit, which is that adjusted gross income limit. And there are some things that a taxpayer can do if they are close to that phase out limit in the way of bringing down AGI. And then some of the few things that Blake mentioned during the deduction slide is you can start thinking about maxing out your IRA or 401k contributions. If you're an educator, and we'll get to a couple of the topics for educators later on, but if you are an educator and you have expenses for your classroom, those can also help with bringing down your AGI, or QCDs if you're above the age for taking RMDs from your account. All those can help with bringing down AGI and to get closer to an income level that is before the phase out. So just some ideas to think about. But it's a little bit about the child tax credit. And then moving on, there's also some literature on the child and dependent care credit. Now, to be clear, this is a totally separate credit. And there are some new stipulations to this new child dependent care credit that was passed with this bill. So a few of the important things to notice are that the maximum credit rate, which is for taxpayers that are within the $0 all the way up to $15,000 of AGI, get 50% of the full benefit. So if you have one kid and you pay for a bunch of these childcare costs, like a nanny or like a childcare center, you will receive 50% of the $3,000 for one kid, or it is 50% of $6,000 for two kids or more. And that's just for the first bracket of AGI. And from there on, you'll see a decline in the percentage of the total credit you can take. And a few examples of this is for single filers, if you have a kid, the phase out after the $0 to $15,000 in AGI, it goes to 35% of the full credit if you're within the range of $15,000 of adjusted gross income all the way to $75,000 of adjusted gross income. And you'll see this not just with the single filers, but for the joint filers as well. Some of the brackets will change a bit, but the big points are that the minimum percentage that you can take if you've got children that you're paying dependent care for is 20%. So again, if you've got one kid that you're paying a bunch of childcare costs for, and you make more than $105,000 as a single taxpayer, you'll get 20% of that $3,000 credit for the dependent care. And then the same goes if you have two kids, so it'll be 20% of the $6,000 available for that credit as well. And then that about sums it up for the credits for child tax credit and dependent care.
Okay, and I'm going to talk about Section 199A, or what we call the QBI. So this applies to business owners, and this is one we weren't sure that was going to stick around, but it has been made as permanent as anything can be anymore. It's technically codified right now, but there's nothing to say that the next Congress won't change all of this. So nothing is really permanent anymore, but we know it won't sunset like we expected to happen to the Tax Cut and Jobs Act. So if you have a business that's a sole proprietor, an LLC, S corp, etc., everything other than a C corporation, you're entitled to this 20% of QBI, a qualified business income deduction. So the rules in terms of QBI hasn't changed. The one thing that did change is there are phase outs with QBI, and this is a topic that is very complicated, and we'll write more on it. And for your business owner clients, we'll obviously be discussing it in more detail with you. But the phase out range has been increased a little bit, so it won't phase out as rapidly as it did before. And then also it's now inflation adjusted, and there is a minimum $400 deduction for people that have at least $1,000 of QBI. So the important thing to note is it's still around, it's still applicable. The phase out ranges have changed a little bit, but for all intents and purposes, QBI kind of exists as it did prior. And we'll be touching on a lot more detail about QBI and how it applies, et cetera, in additional webinars and content. And then I'm also going to talk about the estate and gift tax exclusion. This is one there was a lot of chatter about because the current estate tax exclusion and gift tax exclusion was almost $14 million, $13,999,000 essentially. And if TCJA had sunsetted, it would have gone back to roughly a $7 million estate and gift tax exclusion, which means a lot more people would have been subject to estate taxes. The OBA essentially not only makes permanent the estate tax exclusion, it actually increased it to $15 million. So for those of you that have done planning and maybe you've already given away your exemption, you'll have a little bit of extra money to either give away while alive or to use at death. So it's $15 million for 2026. And then it's also still going to continue to be adjusted for inflation. So what this means is the vast majority of people do not have to worry about estate taxes. Now, there are some states, Washington and a few others, Nebraska, that have estate or inheritance taxes that don't necessarily conform to these rules. And so specific states, we still have to worry about estate tax planning. But for the most part, all we're worried about now is, what kind of income tax planning can we do related to death? What should we be doing to get the stepped up cost basis, et cetera, rather than worrying about how do we get things out of your estate so that you don't have to pay the 40% estate tax. the extension of this to be made permanent and the increase in the benefit. If you're a married couple next year, you've got $30 million excluded from your taxable estate. So the vast majority of people aren't going to have to worry about estate or gift taxes going forward.
Good evening, everyone. I'm just going to jump right into the mortgage interest situation, which remains largely unchanged from what the current rules are. So the Tax Cut and Jobs Act reduced the amount of deductible loan interest from a $1 million loan down to $750,000 loan, $375,000 if you're married and filing separate. And now this rule has now been made permanent. And as everyone has been saying tonight, Jim mentioned, permanent is until Congress decides to change it. So it's important to note there are no adjustments for inflation on this. So, something to keep in mind is we know that housing prices continue to rise everywhere. Now that $750,000 is cumulative for all of your loans. That would include your primary residence, your vacation home, and the HELOC loans when they are deductible. Now, HELOC loans remain deductible when they are used for building or improving the taxpayer's property. The one change that has kind of occurred with this is you now have the ability to deduct your mortgage insurance premiums, and that will be starting in 2026. So for those homeowners that were not able to put 20% down and are required to have that mortgage insurance, that's now going to be a deductible item for them. So going to move on now to the state and local tax deduction, or SALT as it's often referred to. And this has the possibility of having one of the biggest impacts of the OBA changes, and that's especially for taxpayers that are living in high tax states, such as those of us in California. The Tax Cut and Jobs Act had raised the deductible, the standard deduction, to quite a high level, to the point that only 90% of tax filers were actually using the standard deduction. So very few were actually itemizing. And so now that SALT cap is going to go from $10,000 up to $40,000 starting in 2025. So this is one of the changes that's going to be occurring in 2025. That will increase 1% through 2029, and then it's going to drop back down to that $10,000 cap. Now, it's important to note that that $40,000 deduction is for all filing statuses: single, head of household, and married filing jointly. But for those that are married filing separate, it's 50% less, so $20,000. So a pretty big hit there for married filing separate filers. That deduction cap is going to be reduced by 30% of your modified adjusted gross income over $500,000. So essentially, for every $1,000 of extra income over $500,000, you're going to lose $300 of that deduction. And there's a $100,000 phase out on that. So once you get to $600,000, it's going to drop back down to that $10,000 amount. So just as an example, if someone were to make $600,000, they're actually going to be paying tax on an extra $130,000. That extra $100,000 of income and that $30,000 of the SALT tax or SALT deduction that they're going to lose. So if you're in a 35% tax rate, that's going to push it up to over a 45% marginal tax on that extra $100,000. So last thing to remind you about is that that difference on the SALT deduction for married filing separate, and the income levels on that are $250,000 with a $50,000 phase out. Now, when we're talking about SALT, we're talking about state income taxes, and that would be your withholdings and your estimates, your local income taxes, those property taxes, sales and personal property taxes as well. So there's really a lot of strategic planning that can go into this new cap limit, this new SALT cap limit. First, you want to make sure that you're making your state and local tax payments during the calendar year. And as Blake had mentioned previously, those phase out levels, you really have to watch those. So if you're getting close to that $500,000 phase out level, you want to be looking at some additional retirement contributions, HSA contributions, um, maybe harvesting some capital losses, and for business owners, accelerating any kind of business expenses that you might have. And speaking of business owners, that pass-through entity tax is remained. So for those partnerships and S corporations, they're allowed to pay their state taxes through the business and take that as a business deduction. Another big strategic area that we're going to be looking at on this increased SALT deduction is through Roth conversions. And again, being very, very mindful of that phase out area. But with tax rates at historical lows and these extra deductions that will allow probably a lot more people to itemize than in the past, there's going to be some opportunities over the next 5 years to do some Roth conversions. Another thing that kind of came up when we were talking about this is making sure that you're tracking your medical and charitable expenses. Again, with 90% of people using the standard deduction in the past, people may have kind of forgotten to do this. So, with the opportunity for more people to itemize with this increased SALT deduction, it's going to be important that you're keeping track of all those expenses. And then finally, one other opportunity is to bunch tax payments. For example, those of us here in California, we can split our property tax payments up, one towards the end of the year and then one early in the following calendar year. Well, it might make sense to make that full payment in that one calendar year if it gets you to the point that you might be able to itemize.
All right, so I'm going to talk a little bit about casualty and wagering loss deduction. So there's been slight changes here for you gamblers out there. You may be aware that you can deduct gambling losses to the extent of your gambling gains. So you made $100 at the blackjack table or whatever, and then you lost $100 playing roulette. It's a wash. The rule change for next year is not favorable. So essentially what they've done is they've said you can only deduct 90% of your wagering losses. So for example, if you had normally had $10,000 of gambling losses and gambling gains, you're only going to be able to deduct 9,000 of those losses. So you're going to have to pay $1,000 on those gambling winnings, even though essentially you were a net wash. So it's not a positive, and it's just something we'll have to deal with. Is just know that you're not going to be able to fully offset your gambling winnings anymore. In terms of casualty losses, the rule hasn't changed much. The difference is starting next year. If right now the rule is you can only take losses if it's a federally declared disaster, and then also you can only deduct what the insurance company doesn't cover, and it has to be more than 10% of your adjusted gross income. Next year the rules is essentially the same, but if the state declares a federal disaster, all the fires we have or the flooding or whatever is going on, you'll be able to take that casualty loss even if the federal government doesn't declare a disaster. But again, you can only deduct what the insurance company's not paying, so what you've gone out of pocket for, and then you can only deduct what exceeds 10% of your adjusted gross income.
All right, so these next two slides, the no tax on tips and overtime, this is pretty much brand new legislator, and it might not be applicable to everybody that's watching currently, but we thought it'd be pretty interesting to kind of lay out what the rules and deductions are going to be for both tips and overtime. So to get started, just as a precursor, the deductions for no tax on tips and overtime, those are going to be for your federal income tax, not for the FICA tax. So it'll still be grouped as total income for the FICA tax calculation, which is for Social Security and Medicare. But to start with tips, you're going to be able to deduct up to $25,000 of qualified cash tips. And this is not going to be for anybody in any industry that receives tips. It's going to be specifically for service workers like servers or bartenders, people that work in restaurants. To my knowledge, it doesn't qualify for like musicians or for people that are in SSTBs, which that stands for specified service trades and businesses. And some examples of those businesses where there might be tips are either your consultants, your lawyers, your accountants, a lot of the more professional services related industries. But for those servers and bartenders, they'll be able to deduct $25,000 of qualified cash tips. And then just a few of the requirements for the tips to be, these qualified cash tips is it's got to be voluntary. So it's not going to be, the service charges that you see at restaurants where they, charge a 3 or 4% service fee. That won't count, even if it is given as tips to their employees. It has to be voluntary. So that's a bit on tips there. And then like overtime, you'll see in the next slide, there are phase out limits. So, beginning at 150,000 of modified adjusted gross income, and then from then on it'll be phased out. But yeah, so moving on to overtime, this might have a greater effect on more people. So with overtime, it's going to be a lesser amount than with the tips. So you'll be able to deduct up to either 12,500 for single filers or 25,000 for married file and joint. And again, these have to be qualified overtime wages. And for the workaholics out there, this will be pretty nice if you're able to take this deduction. But it's the qualifications for it to be able to deduct it on your return are that the overtime hours have to be in excess of your regular rate pay. So an example we have here is that, if an employee typically earns $20 an hour for their job and their overtime rate is $30 an hour, it's only that $10 spread is what's going to be deductible for your tax situation. And again, you're going to have the same phase out limits as you did with the tips. So starting at 150,000 of MAGI. So like I said, this is pretty brand new literature. You saw it being talked about on the campaign trails for both sides of the aisle, and now it's finally here. So yeah, it's not going to affect everybody, but there is going to be a certain part of society that will benefit from it. So
awesome. Thanks, Corey. So another new, more revolutionary change coming out of this new tax legislation was the introduction of a deduction for car loan or auto interest. So this raised some buzz as well. So this is going to be considered a below the line deduction to where individuals could potentially deduct $10,000 each year of auto loan interest. And there's some important criteria that you need to understand for those that are seeking to buy cars in the next subsequent years here. In order to benefit from this auto loan interest deduction, you have to buy a new vehicle, right? So used vehicles wouldn't qualify, it's for new vehicles. As well, it has to be purchased, right? So you can't lease a vehicle and benefit from this new tax deduction. So it applies to newly purchased, not leased, and then it needs to be considered a qualified passenger vehicle. And there's a couple different things to know with qualified passenger vehicles, but the most important is the final assembly of the vehicle must occur in the United States. Now, it shouldn't be too difficult to vet whether the vehicles have final assembly in the US. From our standpoint, there's probably going to be a lot of auto dealers out here marketing that their automobiles have final assembly in the US. So it should be pretty easy to see if you meet that last requirement. But it's specific in the bill that it says the final assembly must occur in the United States. Now, like with some of the other new deductions we talked about, the car loan interest deduction has a phase out limit, right? So in order to take advantage of this full deduction, single filers need to have modified adjusted gross income less than 100,000. And then for married filers, it's less than 200,000. So for those singular filers, their deduction starts to get phased out once income increases 100,000, and then for married filers, that's 200,000. So again, when we're talking about tax planning, for those that are interested in purchasing vehicles and they're kind of at the cusp of maybe qualifying for this auto loan deduction, what tactics or strategies can we execute this year to get your modified adjusted gross income under those respective limits? And we've been talking about them during the whole presentation, so I'm not going to reiterate all of them, but the contributions from the retirement accounts, the HSA, accelerating business expenses, etc. But the key point is, when it comes to these new deductions, we need to be very mindful of these phase out limits and do as much as we can prior to the end of the year to try to reduce our income so our deduction is not subject to the phase out. Another interesting point about this auto loan deduction is it does qualify for refinanced loans. Now, it's still unclear, and we were doing a lot of research on this, whether the purchase of the vehicle needs to be in 2025 or it could happen in earlier, such as last year, whether you can refinance and take advantage of the auto loan deduction. But from what it seems like, this would be cars purchased in 2025 and refinanced, say, later in the year, or refinanced in 2026 and beyond, to where you could benefit from this auto loan deduction. Now, this is going to be effective for tax years 2025 through 2028.
Okay, we're going to talk about the Trump accounts now. These are obviously brand new, and this was part of the legislation that probably had the most iterations during all of the discussions that were going on about this. But what these ended up being are basically retirement accounts with two major exceptions. One, the account can only be opened and funded until the year that the individual turns 18. And these accounts can also be funded if there's no earned income from the beneficiary. So unlike traditional IRAs and Roth IRAs that require earned income, these can actually be contributed to without any earned income. There's a couple other things about both parents must provide work eligible Social Security numbers. And like other retirement accounts, these will not impact FAFSA. Now, there are some investment restrictions on these accounts. They can only be invested in mutual funds and ETFs that track stock market index that's comprised primarily of U.S. equities. So that would be things like the S&P 500, U.S. small cap index, things like that. And it's not going to allow for any kind of risky investments. So no trading options or Bitcoins in these accounts. And it does not allow for investments with an expense ratio of greater than 0.1%. Now, the government is going to provide a one-time credit of $1,000 for these accounts for all individuals that are born between 2025 and 2027. You will need to make an election to claim that $1,000 credit. You're going to, in other words, have to opt in. Now, exactly how you do that has not been determined yet. So more information to come on that. And these accounts can't be opened until July of 2026. So again, for anyone qualifying for this credit in 2025, there'll be some more information on how they can actually get that credit. Now, there's some rules that are going to apply to these accounts before the year the beneficiary turns 18. And basically, you can contribute up to $5,000 per year until the year that they turn 18. And that will be adjusted for inflation. Now, these are non-deductible contributions. There will also be an opportunity for employers to contribute $2,500 towards this, but that will count towards that $5,000 cap. There can also be some additional contributions allowed from government or charitable organizations if you're lucky enough to get any of those, but those will be excluded from income. As we discussed on the previous slide, there's going to be those limited investment rules that apply. And this is important to know that there's no distributions that can be taken from these accounts until the year the beneficiary turns 18. You also cannot roll these accounts over into other types of IRAs. You can roll them over into other Trump accounts, or a 529 ABLE account in the year when the beneficiary turns 17 if they're eligible for this type of account. So a little bit of flexibility there in terms of being able to use an ABLE account if there's eligibility there. The rules for these accounts then basically change in the year that the beneficiary turns 18, and they kind of become more like standard IRA accounts. So same kind of rules that apply to those are going to apply to these Trump accounts. And distributions will be subject to early withdrawal penalties before 59 and a half. Your investment opportunities will increase. You can pretty much invest any way that you do in an IRA account. Now, those withdrawals that you made that were non-deductible after tax, those will come out tax-free. But any withdrawals of the growth or the excluded contributions, those are going to be taxable at the individual's tax rate at that time. There's still some clarity that needs to come on these accounts, but it's anticipated that they will most likely follow similar rules to other IRAs with in terms of the required minimum distribution and the 10-year inherited IRA rules that currently apply. So, but again, there will be a little bit more clarity coming on those in the future.
All right, thanks, Rob. So another brand new tax credit is taking effect in 2027. So this is going to be a federal incentive for those that are enticed to contribute to scholarship granting organizations. So what's a scholarship granting organization? Well, it's going to be a nonprofit entity that raises and distributes funds for private and religious school scholarships. So what's important here that this is not for public school scholarships. It's exclusive to private and religious school scholarships. And the credit's going to be up to $1,700. And it's essentially going to be to those people who make qualified contributions to these organizations within their specific state. So what's likely going to happen, at least what they told us, is each state's going to provide a list of all the eligible scholarship granting organizations, and then you can decide if you want to contribute to them. They need to be an organization that specifically funds for K through 12 education. So this is really for kindergarten through 12th grade and not college scholarships. And then, like I said, this is going to take place in 2027.
All right, thank you, Blake. Before I dive into the educator expenses, I do want to say that, shout out to all the educators out there. I was happy to take over the part of this presentation because my mom's a teacher and a lot of my mom's friends are also teachers. So I was happy to see that there is a positive part of the bill for those teachers. And to pretty much sum it up, if you didn't know before, there was a educator expenses deduction capped at around $300 for your taxpayer, or $600 jointly if both husband and spouse are teachers together. Now, with this new bill, there's going to be not just the $300 above the line deduction. There's also going to be an unlimited amount of unreimbursed out-of-pocket educator expenses. So if you know a teacher, you know that they usually shell out for all different kinds of toys and materials and markers, and there's just an endless amount of things that teachers need that don't always get reimbursed from their districts. So this will be a nice little boost for those educators. And like I said, it's not to replace the 300, it's on top. So with these uncapped, unreimbursed out-of-pocket costs, it's going to be something that's included on your itemized deductions. So as we've been kind of saying throughout this presentation, there's your AGI, which is your income, among with other things like educator expense, like the $300 cap that we had before, or your contributions that all factor into your AGI. Whereas with the modified AGI, it's everything that was just included, but also with the standard deduction or with the itemized. And this uncapped amount for unreimbursed educator expenses will count towards those itemized deductions. So this is a bright spot, in my opinion, for the bill, and definitely going to make an impact for those educators out there.
Yeah, just to add a little bit to that, you're only eligible for this, and Corey just hit on it, is when you take the itemized deduction. So
Mhm.
what we talked about earlier in the presentation is the standard deduction is a lot higher, especially for those that are over the age of 65. So only the people that are itemizing deductions are going to benefit from this unreimbursed additional deduction. So from a financial and tax planning standpoint, if you're an educator or an educator that maybe is on the cusp of itemizing deductions, it could be worth employing some other strategies to push your itemized deduction over the level of your standard deduction, so you benefit from taking advantage of these unreimbursed out-of-pocket costs. How can you do that? Well, you can do that through charitable contributions, through making your state estimated tax payments through the year, that type of stuff. So that's a good segue to continuing the theme on education, specifically related to 529 plans, which are education savings accounts. What's new coming out of the new tax legislation is an expanded use of 529 plans for more qualified expenses. So what we're going to go over the next two slides is two additional changes to the 529 plans, one of which impacts K through 12 education, and the second impacts post-secondary credentialing expenses. So prior to the passing of this legislation, individuals could use a 529 plan and take up to $10,000 from it per year per student to pay for K through 12, kindergarten through 12 expenses. Now, with this new legislation, starting next year in 2026, the cap has gone from 10,000 up to 20,000. Meaning, if you're relying on your 529 plan to pay for your kid's private school, you can now withdraw up to $20,000 per year from it in 2026. The other thing to note here is this expanded use of eligible expenses for the 529 plan that we'll go over. You can start taking those now after the enactment date of the legislation. So now that we're past July 4th, you could take that now. However, the 10,000 cap that we're used to for K through 12 still in effect for 2025. It's 2026 where it goes up to 20,000. So what are some of those additional eligible expenses? So starting off with grades K through 12, you can now use your 529 plan for curriculum and curricular materials, fees for standardized tests, AP exams, college admission exams, online educational materials, tutoring outside of the home, fees for dual enrollment, certain educational therapies. So they really expanded and broadened the use of what you can use 529 plans for the K through 12 schooling timeframe. They've also made a change as well for post-secondary, so college and a continuation of your education beyond that, to where you can now use your 529 plan for tuition fees, books, other programs that are required for your enrollment, exam fees to obtain or maintain a credential, or fees for continuing education to maintain or renew a credential. So the example we like to give is, myself and Jim and Rob shortly are certified financial planners, right? So we have this credential that we studied and we paid education for. So those CFPs can now use the 529 plan to pay for their costs, since it's eligible under this new legislation.
All righty, so let's talk about charitable deductions. Not a lot of changes here, but there are a few, some of them not so great. Essentially the positives are, you may remember during COVID, we had this, below the line charitable deduction for non-itemizer. So if I remember right, the numbers were like 300 or 600 that you could take regardless of whether you itemized or not. And those can be made to public charities, not to a donor advised fund, things like that. So that's been reinstated, but the limits are a little higher now. It's 1,000 single, 2,000 married filing jointly. So even if you don't itemize, if you're making charitable contributions, you'll be able to at least deduct 1,000 single, 2,000 married. Those are cash contributions. So your donations to Goodwill, et cetera, don't apply. And there's no floor on this. And so what that means is the new that's kind of ugly is there is now a floor on your itemized charitable deductions. And so essentially the first 0.5% of your AGI will not be deductible for charitable deductions going forward. So we've got an example here. Let's say you make $100,000 at your AGI, 0.5% would be $500. So if you made a $5,000 deduction, the first 500 would not be deductible. You'd only be able to deduct $4,500. So these, plus like the example in gambling and some of these others, there have to be revenue raisers in here for all of the extra bonuses like no tax on tips and all that kind of stuff. So this is an example of a revenue raiser. So if you're itemizing, you're going to see some of your charitable deductions be disallowed. It's not terrible, but there is that small floor. And there's a whole ordering system that we don't need to get into tonight. Just know that you have this now below the line deduction. If you don't itemize, if you do itemize, you'll get to continue to do that. There'll just be now this 0.5% of AGI ding that you will incur.
Yeah, and just adding a little bit to that too, that additional below the line standard deduction, that 1,000 limit per single filer, 2,000 for married filing jointly, that takes effect in 2026. So that's not for 2025. Now for the itemizing, what we've been talking with our clients about, especially those who have donor advised funds, is that bunching strategy that Rob alluded to earlier is, hey, if you're someone that likes to give to charity, maybe you can do a larger charitable contribution this year in 2025, say to a donor advised fund or some of your favorite charities, to take advantage of the last year before this floor takes effect, right? Because the AGI floor for itemizing doesn't start until 2026. So this year, 2025, is a really good year to make your charitable contributions due to the fact that we don't have that floor. So you're going to get a deduction on the entire amount. And of course, this is more relevant for higher income taxpayers. So something to keep in mind with that, and especially all the additional itemized deductions we talked about, such as the increase in SALT, et cetera.
Okay, I'm also going to talk about qualified small business stock, QSBS. These have been around and they were scheduled to sunset. Essentially what these are, and again, we won't go into a lot of detail on the business stuff in this particular webinar, but if you create what's called a qualified small business company, and there's limitations on who can create one of these C corporations, you can get capital gains exclusion when you essentially sell the stock. So if you hold QSBS stock for 5 years, you can essentially have 100% exclusion. And then the total exclusion amount you can see there increased from 10 million to 15 million. So these can be very attractive for those of you that are considering starting a business. And again, one of the things we'd have to work through with you is, should it be a C corporation to take advantage of this, or, should you stick with the S corp or the LLC or whatever? So we'll have more detail on this in a blog post on our webinar shortly, but just know that it's still around and the benefits have now kind of been tiered, and we'll have it at least for the time being.
Thanks, Jim. Well, hopefully everyone's hanging in there. A lot of numbers that we've gone over tonight, but we are getting close to the end here. So just going to talk briefly here on 1099s, some changes. First to the 1099K, which is like third-party payment processors. Those would be, companies like Venmo or Cash App or PayPal. So the payment providers were scheduled to send out 1099Ks to sellers who had $600 more of transactions, which really isn't a lot. So, and that was due to the American Rescue Plan Act of 2021. But it's never really been enforced by the IRS, just due to a lot of confusion among sellers about exactly what needed to happen. So going forward, that transaction total is going to be $20,000, and the number of separate transactions has to be greater than 200. There's also a couple changes to other 1099s, mainly the NEC and MIS for MISC, the miscellaneous, for businesses that are paying suppliers and independent contractors. They will now need to, that amount has been $600, and that amount is now going to increase to $2,000 and be adjusted for inflation going forward.
All right, back to me. So this is another one of the not so great provisions. And again, they're looking at revenue raisers, and then also they're looking at kind of shifting what types of energy they want to promote in the future. So a lot of these clean energy credits are going to be eliminated. For example, the first two here, the previously owned clean vehicle credit. So, if you bought a used electric vehicle, you would have been able to take a credit for that. That now will be eliminated as of September 30th. So if you're going to buy a used EV, you need to do it before September 30th to take advantage of the credit. The same with the clean vehicle credit. So, you buy some sort of new EV, you normally could have taken a credit. Those are going to be eliminated as of September 30th. And then on the next slide, we've got some of the improvements related to homes that are also being eliminated. So, for example, the energy efficient home improvement credit, those are windows and things like that to improve energy efficiency. That's eliminated at the end of the year rather than the end of September, as is the the clean energy credit, the solar credit, ending end of this year. So if you've been considering putting solar on your home, you have to do it before the end of the year, and it has to be paid for before the end of the year. It can be installed after December 31st, but you have to pay for it this year. So all of the clean energy credits are being essentially eliminated this year. A couple of the business ones are next June, but for the most part, if you've been looking at taking advantage of new windows or an EV or solar, you've got a very short time frame to get that done and to be able to take it the last year of these credits.
All righty.
Okay.
Well, like we kind of talked about, it was a lot that we threw at you, but we didn't cover everything, right? So there's certainly some parts of the legislation that we didn't get to, but we focused on the most salient ones that would impact the most amount of people.
Yeah. And so, we have a couple minutes, so we're happy to open it up to a couple of questions. And again, if we can't get to your question, give us a call, give us an email. Our contact information's here. We're happy to set up a consultation. And for those of you that are financial planning clients, obviously, as we do our year-end reviews, we'll be discussing this in much more detail with you. But opportunity for you to ask a question or two if you'd like, or if not, like I said, reach out and we're happy to spend a bunch of time with you going through this. The webinar is being recorded, so it will be posted to our website. And also look for a lot more information in our newsletter and our website blogs, etc., that will dive into a lot more detail about this. It's a lot to digest, and we're still working our way through it.